You've probably noticed your bank app got smarter. The fraud detection flagged that purchase in Denver 3 seconds before you made it. Your credit score shifted by 12 points last month, and you still don't know why. Nobody told you it happened, nobody sent an email. The system just adjusted. That's not a glitch. That's the beginning. Right now, in 2024, artificial intelligence is being woven into every layer of your financial life, and by 2026, the transition will be nearly invisible. You'll wake up one morning and realize the money system you thought you understood no longer exists. The mechanisms that determined your wealth, your borrowing power, your retirement, they've been reprogrammed. And the most unsettling part? The AI didn't ask permission. Let's talk about what's actually happening behind the dashboard. Every single time you swipe a credit card, apply for a loan, or move money between accounts, a decision tree that would take a human analyst 3 hours to process gets solved in milliseconds. But here's what you don't see. That decision tree is becoming an AI neural network. It's not following rules anymore, it's recognizing patterns you didn't know existed. Patterns that determine whether you deserve money. The Fed released a report in late 2023 that almost nobody covered. They studied 16 major U.S. banks and found that 73% had already deployed machine learning models for credit decisioning. Not recommendations, decisioning. Meaning an algorithm is saying yes or no to your mortgage application, and the bank's human loan officers have become theater. They exist to explain the AI's choice, not to challenge it. Here's the mechanism nobody talks about. Credit scoring has always been opaque. You get a 3-digit number from Equifax or Experian, and you're told it predicts your risk. But at least with the old FICO model, there were rules. 30% of your score is payment history. 15% is length of credit history. It's a formula. You can game it if you understand it. An AI-based credit system doesn't work that way. It's trained on billions of data points, not just your payment history, but your browsing behavior, your location data, your social media activity, your shopping patterns, the time of day you make purchases, the frequency of your ATM withdrawals. Your financial profile isn't a number anymore. It's a multi-dimensional map of your entire existence. And here's where it gets uncomfortable. The model doesn't have to tell you why it denied you. In 2020, a woman in San Francisco was denied a credit card increase. She had perfect credit, 0 missed payments, 6-figure income. When she called and demanded an explanation, the bank literally couldn't give her one. The AI model had flagged something, maybe a pattern in her purchasing that resembled fraud risk from someone in her demographic. Maybe a correlation between her browsing history and late payments made by people with similar profiles. But the bank couldn't articulate the causal link because it didn't exist. The AI had found a statistical correlation so subtle that even the engineers who built it couldn't explain it in human terms. This is called the black box problem, and it's about to become your financial reality. The Federal Reserve knows this is coming. In March 2024, they quietly updated their guidance on algorithmic bias in financial services. The update essentially says, if your institution uses AI for credit decisions, you need to monitor for disparate impact. Translation? They're acknowledging that AI systems will discriminate, and they're telling banks to measure how much, not to prevent it, to measure it. Because here's the truth they're not saying out loud. Some discrimination is mathematically inevitable. If you train a neural network on historical lending data, data that includes 60 years of redlining, data that reflects systemic racial bias, the AI doesn't erase that history. It optimizes for it. It finds the most efficient statistical correlations, and those correlations are poisoned. A study from MIT in 2022 showed that AI credit models trained on historical data were 40% more likely to deny credit to minority applicants than human loan officers making the same decisions with the same information. 40% more likely. The banks already know this. They know that by 2026, when their AI systems are fully integrated, they can make the same discriminatory lending decisions as before, but now they have plausible deniability. They can say it's mathematical. They can say it's objective. They can say the algorithm made the call, and the algorithm is neutral. But algorithms aren't neutral. They're optimized for whatever metric they're trained to optimize for. And the metric is profit. Now expand this beyond lending. Your insurance rates are already AI-driven. Your health insurance carrier is using machine learning to predict which customers will be expensive, and they're jacking your rates accordingly. Your car insurance company has access to your telematics data, your location data, and they're pricing you based on when you drive, where you drive, and how fast you accelerate. It's all algorithmic. It's all optimization. By 2026, this extends to your investment portfolio. Robo-Advisors, software that manages your retirement accounts, control over $2 trillion in assets right now. That number doubles every 3 years. You don't have a financial advisor anymore. You have an AI that rebalances your portfolio, that decides when to buy and sell, that calculates your asset allocation based on goals you set once in a questionnaire 4 years ago. And when that AI crashes, or when it decides to liquidate positions simultaneously with thousands of other AI systems, the market moves in ways humans can't control. This happened on a small scale on August 5, 2024. The Nikkei index in Japan dropped nearly 13% in a single day. The official narrative blamed rate hikes in the US, but traders later realized something else was happening. Algorithmic trading systems, spooked by initial volatility, sold into the decline, which triggered more selling from other algorithms, which triggered more selling. It was a cascade. Humans were frozen, watching the algorithms trade against themselves. That's going to happen again, in the US market, in your 401k. But there's a deeper layer to this that almost nobody is discussing, and this is where the real risk lives. Right now, the Federal Reserve maintains control of monetary policy. The chair of the Fed holds a press conference and announces interest rate changes, and the entire financial system adjusts accordingly. It's centralized. It's human. But the Federal Reserve is currently running pilot programs, approved by Congress, barely reported by media, that allow commercial banks to participate in something called real-time gross settlement using AI-mediated decision-making. Translation: instead of the Fed telling banks how to manage money flows, AI systems owned by the banks are making those decisions. The Fed set the parameters, but the execution is autonomous. Distributed. Decentralized, almost. By 2026, this architecture becomes standard. You'll still have a Federal Reserve, but the actual control of money flow, the moment-to-moment management of trillions of dollars, will be handled by neural networks that make decisions faster than human central bankers can respond to. The Fed becomes a figurehead. Here's what keeps people awake at night in central banking circles. What happens when those AI systems disagree? If JP Morgan's credit allocation AI decides to tighten lending because it's detected some pattern suggesting recession, and Bank of America's AI independently comes to the same conclusion, they both tighten simultaneously. No coordination, no debate. Just two massive neural networks making the same move. The impact cascades. Lending freezes. Small businesses can't access credit. The recession the AI was trying to prevent becomes inevitable. The algorithm was right, but it was self-fulfilling. There's also the question of AI alignment across different institutions. Right now, all the major banks use AI credit models trained on different data sets, with different architectures, different optimization functions. They're not coordinated. But as these systems become more sophisticated, as they integrate with clearinghouses and payment networks, they begin to operate in concert. Not intentionally, but mathematically. And then there's the manipulation vector that nobody wants to discuss publicly, but every finance regulator is terrified of. What if someone, a nation-state, a coordinated group of traders, an insider with access, figured out how to feed poisoned data into an AI system that controls market movements? What if you could trigger a flash crash not through manipulation of human traders, but through subtle manipulation of the training data that teaches an AI to make decisions? In 2023, researchers at Google and Stanford proved you could do exactly this. They showed that by inserting just 3% poison data into a training set, you could completely flip the behavior of a neural network without anyone detecting it. The AI would still pass all its testing protocols. It would still seem to be working correctly, but it would be fundamentally compromised. Now imagine that applied to the banking system. Here's the uncomfortable reality that sits underneath all of this. Nobody actually wants to slow it down. The banks are moving to AI because it's profitable and because it gives them regulatory cover. The regulators are allowing it because they're terrified of appearing anti-innovation. The government is subsidizing it because they're convinced AI will solve economic problems it actually might create. So we're sliding into this future not because it's safe, but because it's convenient. By 2026, the transition will be mostly complete. Your credit score will be calculated by an AI model you can't see, based on data you didn't know was being collected, using logic you couldn't understand. Your insurance rates will be set by algorithms. Your investment decisions will be made by neural networks. Your access to credit will be determined by statistical correlations between you and people who look like you, who live where you live, who shop what you shop, and who defaulted on loans 5 years ago. And you'll go about your financial life without realizing anything fundamental has changed, because the system will still look the same. The apps will still work. You'll still get notifications when money moves. The dashboard will still feel familiar. But you're no longer negotiating with humans. You're negotiating with mathematics. The trap is that you can't opt out. Every financial institution is moving in the same direction. There is no alternative system. You can't go to a bank that uses old-school human credit decisions because that bank would be outcompeted within a quarter. It would be offering higher rates, slower service, worse terms. The AI banks would simply take all the business. So the transition is inevitable. It's also irreversible. Once the neural networks are trained on historical data, once they're integrated into the payment infrastructure, you can't unpull that thread. You can't suddenly switch back to human decision-making at scale. The humans are gone. The final twist, the part that makes this genuinely unsettling, is that the AI systems will be right more often than humans were. They'll catch fraud more effectively. They'll price risk more accurately. The system will be more efficient. But efficiency and justice aren't the same thing. A perfectly efficient credit system can still be structurally discriminatory. A perfectly optimized risk assessment can destroy someone's financial life based on a pattern they didn't know existed. The algorithms will be better at sorting people into winners and losers. That's the optimization working perfectly. And by the time you realize what's happened, the decision-making power has already been distributed into a network of systems so interconnected, so autonomous, so mathematically entangled that no single human or institution could untangle it even if they wanted to. This isn't a dystopia from a movie. It's infrastructure currently being installed in your bank. The money system isn't being taken over in 2026. It's being reprogrammed. And the frightening part isn't that it's happening. The frightening part is that it's happening so smoothly that most people won't notice until they collide with it personally. A denied loan they can't appeal, a rate they can't negotiate, a score that shifted for reasons nobody can articulate. By then, the system will be too embedded to argue with. The algorithm doesn't negotiate.